done and said, and there's a good chance that we will participate in that euphoria today, especially after the statements from Mario Draghi and from US President Donald Trump. Ingredients are in place for our market to have a rally. In fact, it looked like that was the case yesterday when the markets were closing, that perhaps some kind of near-term bottom could be in place. But the big question would be, will this rally be vulnerable to be sold into, or has the market made a bottom? We'll find out. This is Bazaar Morning Call. I'm Anuj, and with me Sonia and Surabhi. Good morning.
Hi, good morning, Anuj. Good morning,
Sonia.
Surabhi.
Good morning, Anuj.
You were telling me yesterday, Anuj, that something is needed to scare the bear, right? And I mean, there are weak bears, there are strong bears, but we need a good trigger. Is this that trigger to take it forward? We did see a bit of a short covering rally yesterday, and now after 2 days of FI selling, there's been some buying by FIs as well. You think the rally could continue?
Yeah, like we were discussing in closing bell with Surabhi, yesterday the market gave you signs that it was ready to reverse. Only thing you needed was not a large FI selling, and that way I think the market got what it wanted. We still don't have the FI options and futures data, so it's tough to sort of analyze that. But look, we'll go through this Bank of America fund manager survey as well, which is indicating quite a bit of bearishness. I think ingredients are in place for a decent emerging market rally, because this is money printing, which is at it again. So what will happen, what may happen right now is so many shorts in the system because of this big emerging market rally. Some of the shorts will be forced to cover, and there's a good chance that India also participates in the rally. However, euphoria is not good for the market, like we have seen in the past. Remember the last rally? Let's not forget that it was the kind of 1,000-1,200 point rally that we had because of the ETF inflows after the exit polls. And look what happened after that. Liquidity-driven rallies will fail if earnings don't catch up. As simple as that. That does not mean that the market will not rally. Of course, the market will rally because globally markets will rally, so you'll participate in that. But as long as earnings don't catch up, the market will will not participate in that. In fact, I tell you one more thing. My first memory of the biggest bull market is the 2003 to 7 phase is when the Fed was consistently raising rates, and that's because you had a very strong earnings growth in India. You had strong inflation, strong earnings growth. That's what makes markets move in the long term, in the medium to long term. These money printing moves make the market move in the near term.
Yeah.
But
it's also hope, right? It's just hope that the market is spinning on. I mean, if you look at what President Trump said, he will be meeting the Chinese premier at the G20 meet, and his statements change on a dime. Yeah. Even Mario Draghi, he said he may provide more stimulus if inflation does not pick up. So these are just data points just on hope.
Yes.
You wouldn't want to bet too much on that.
Exactly. And the point is, stimulus for the markets. I compare it to a patient in the ICU. You're giving him a shot. At the end of the day, it will keep him alive for some more time. But the fact is that rallies would be vulnerable to be sold into as long as the earnings don't catch up. Now, market is also trading at 18 times 1 year forward, so it's not inexpensive market. So to cut a long story short, I think the market may have made some kind of near-term bottom. We'll find out. Let the market, let the market give us an answer. I think today's trade becomes crucial. We'll talk about that as well. But the limited point I wanted to make was that rally is driven by the money printing from the central banks. Normally are vicious. They are very large in nature, but they're vulnerable to be sold into as long as the fundamental data does not support it.
Well, you know what? First things first, a disclaimer that the green you see on Anuj's pocket square and tie, or basically on me, I mean, this is absolutely a coincidence. Who would have thought? And Sonia, you spoke about what can scare the bear. When you have the US president being the perma bull that he is, I think, that's a big bull willing to scare away the bears. Just to go back on some of those tweets, some of them Sonia's already mentioned. Of course, how he sort of took a very direct aim at the ECB president, talking about how, this is perceived stimulus that's coming in. And let's not forget, there's a lot of back and forth that's also happening with the fate of the Fed chair himself, Powell. One of the CNBC senior-most journalists, Eamon Havers, yesterday put that question to the US president, saying what is the future of Powell, because there are reports suggesting that maybe there's some sort of an inquiry, etc. He said, well, let's see what he does today. I mean, that's as loud as it gets. And then, of course, hope around the G20 meeting, which is taking place on the 28th of this month. But having said all of this, Anuj, to come back to today's reality, let's not forget today is the day we're still grappling with the issue. I mean, PNB's bonds are getting downgraded. Jain Irrigation is getting downgraded. These are day-to-day, daily realities which we can't wish away, right?
Oh, yes, we can't. And look, the market's made that distinction. Jain Irrigation is now 25 rupees stock. So obviously, that's one part of the market you should be staying away from. And that is absolutely right. Look, my problem is not that a Jain is down 21% or that, a Reliance Infra is down where it is or a Jet is down where it is. Some of these stocks will, of course, are going out of F&O, and some of these stocks perhaps will not be trading in some point, and that always happens. Do you remember the bull market stocks of last bull market? So many of them, Punj, Lloyd, GMR, most of them have vanished. Same will happen with a lot of NBFCs. The best quality ones will survive, and the worst quality ones, like you've already seen that, for example, the way DHFL has collapsed, that will happen. You're talking about the overall market. And I think in that, yesterday's low is now a line in sand, 11,641, for two reasons. A, you bounced back twice from there yesterday itself, and B, that's also very close to the 50-day moving average. So 11,641 is your sacrosanct stop. And if Indian market also participates in the rally, the caveat that crude is also rising, if we participate in that rally, the 20-day moving average is 11,850. So if this has to be 20 DMA halt, that's something we'll find out. The bank nifty, I think, is interestingly poised because that sort of underperformed a bit. And yesterday's low was, bang in line with the 50-day moving average. The current 20-day moving average is 31,000. There's a 650-point window which is open for bank nifty. And with the way stocks like Axis and ICICI Bank have been strong, all it needs is some more push-up from stocks like HDFC Bank and Kotak Mahindra Bank to perhaps have that 600, 700-point rally. All of this is with the caveat that yesterday's low should hold. If yesterday's low is gone, then all these theories are out of the window. I think this mid-cap churning will continue. You will continue to see stocks falling 20, 30%, especially the ones going out of F&O till expiry. But yesterday, some of the good quality names saw some buying. And there was quite a bit of buying in the nifty junior stocks, which I think is a good thing. So that churn will happen, and you'll have to adjust. You'll have to stay clear of stocks like Jain Irrigation, but you'll have to buy good stocks on decline.
Also, as we were discussing, Anuj, almost always ahead of the FOMC policy, there is the market goes in long, expecting some sort of comments on rate cut, etc. And this time there is an expectation of a rate cut. So you reckon that we could perhaps end at the high point?
Yeah, that's possible. Normally go into the event with long positions. So let's see. But let's find out, because our market has been quite vulnerable. Yeah. So the
and
first
quite
hour
unpredictable.
First hour will tell us a lot about what's happening.
All right, we do actually have some cautious statements coming in from a lot of market experts. So let's get straight to that. First up, Michael Hartnett of Bank of America Merrill Lynch released a global fund manager survey which is extremely pessimistic. It indicates that there is heavy pessimism driven by concerns over trade war and recession. He says this is the most bearish survey of investor confidence since the global financial crisis. 2019 has so far seen the largest jump in cash since the 2011 US debt ceiling crisis and second largest drop in equity allocation ever. So quite cautious there.
Oh yes, and normally when fund managers become so bearish, at times there's a rally as well, because best time to buy is in bear market. Anyway, Akash Prakash of Avanza Capital, he's written in Business Standard that there's a trust deficit in the system as rating agencies and auditors are both under cloud at the moment. Investors will need to see the asset books of the NBFCs and housing finance companies themselves and come to their own judgment about asset quality and profitability. The rumors and noise surrounding certain NBFCs also adds to the confusion and climate of fear. It's very difficult to think calmly, deploy capital and invest in these leveraged financials when you worry about the accuracy of the numbers and ratings which are in public domain.
Okay, that's quite a scary situation to be in when you can't even trust rating agencies on the quality, even auditors on the quality of the audit. But let's get some money market views as well. That's going to be equally important considering what happened across the globe. The rupee has been steady below that $70 a barrel $70 mark, so it's been pretty strong. Pramil Brahmbhatt of Veracity says they do not see any material outcome from the Fed meet, hence the rupee will continue its sideways trade. Trading range for the spot INR pair would be 69.50 to 70. And on the bonds, Dhaval Dalal of Edelweiss says the benchmark 10-year bond fell by 12 basis points to around 6.8% yesterday amidst trading volumes crossing 1 lakh crores. This kind of decline in yields and rise in trading volumes suggests a further building up of bullish positions in long-dated bonds. The Reserve Bank governor's statement on financial stability and expectations of OMO bond purchases also added to positive sentiment. That said, bond prices appear to be stretched from a number of technical signals. Based on that, he expects the 10-year bond yields to consolidate at current levels before charting a new course towards the 6.5% mark in the medium term.
There is a 640-point rally underway on the Hong Kong Hang Seng and its big bull Donald Trump in the house. Over to Nigel for the World View.
Well, that's right. Big bull Donald Trump as well as Flying Mario, both of them played their role overnight. And that's why, in fact, you have the Asian markets that are trading higher. But overnight, you had the US markets. They had a big rally out there. A couple of factors played out. One is hope that China and United States, they can come to a trade agreement. And the second factor is maybe after the tightening we've seen from the Fed, now we're bracing ourselves for some easing as well. President Trump, he put out a tweet yesterday. He said, well, I had a telephone call with Chinese Premier Xi. And in fact, he's hopeful that at the G20 summit later this month, they can call a truce. And in fact, they can come up with an agreement on that front. On the back of that, you had a whole host of stocks in the US markets itself that had a big rally. Some of those trade tension sensitives, all of them had a rally of around 3 to around 5%. Remember, Boeing's the largest weight on the Dow. And when that ends high with a gain of around 4%, definitely helps the Dow to move higher. But President Trump, he had his eye out on Mario Draghi as well. He said that, in fact, the European markets, they are moving higher because what Mario Draghi said, Mario Draghi was talking about easing out them. He's talking about pepping up that market because more stimulus could be on the cards if inflation doesn't pick up. What we saw in reaction was that the euro did fall, the dollar index did move higher, and the European markets, they had a super run in trade yesterday after the bond yields did even move into the negative territory after the bond prices did move up as well. ArcelorMittal, well, that stock was higher in yesterday's trading session. Risk on was back into play. Some of those commodity-related stocks did well. That stock ended high with a gain of close to around 6% approximately. The dollar index, remember, we're bracing for maybe a rate cut in the next couple of months, but the dollar index has in fact moved from around 97 to around 97.7 odd. Quick check on crude oil prices as well. We had Brazil yesterday, the emerging market, that's a commodity play, ended high with a gain of around 2%. Brent crude prices, very comfortable from an India point of view, still holding below $63 per barrel. And the Asian markets, what a big rally we're having out there. The SGX Nifty is saying, hey, we'll participate as well. Maybe a 45 to 50 point bump up is what we'll see after a while. Back to you guys.
Okay, Nigel, thanks a lot for that. Well, for now, the Hong Kong market is just surging. It's almost a 700-point rally that you're seeing across Hong Kong at the moment. Terrific moves across the board there. But you heard Nigel speaking about the ECB President Mario Draghi's comments, which sparked a rally across European equities and bonds. Let's hear out Draghi himself talking about the potential stimulus that he might give out if inflation does not pick up.
We remain able to enhance our forward guidance by adjusting its bias and its conditionality to account for variations in the adjustment path of inflation. And by the way, this applies to all instruments of our monetary policy stance. Further cuts in policy interest rates and mitigating measures to contain any side effects remain part of our tools. And the APP still has considerable headroom in the absence of improvement, such that the sustained return of inflation to our aim is threatened. Additional stimulus will be required.
Additional stimulus will be required. These comments did not go down too well with the US president, as we've been telling you. So hear him out on what he said on Mario Draghi's statements. And not just that, then he gave a double sentiment booster by telling markets that he's had a telephone call, and a very positive telephone call, with his Chinese counterpart. Take a look.
I can tell you that Draghi in the EU, if you look at what's going on with the euro, they have a much different stance than our folks do. As you know, he did something today that was very dramatic, and frankly, it helped that part of the world. So we'll see what happens. They're going to be making an announcement pretty soon, so we'll see what happens. But I want to be given a level playing field, and so far I haven't been. I have a very good relationship with President Xi, and we'll see what happens. I think we have a chance. I know that China wants to make a deal. They don't like the tariffs. A lot of companies are leaving China. in order to avoid the tariffs. I have a very good relationship with President Xi. We'll see what happens. I think the meeting might very well go well, and frankly, our people are starting to deal as of tomorrow. The teams are starting to deal. So we'll see. China would like to make the deal. We'd like to make the deal, but it has to be a good deal for everybody.
Okay, we have a guest now. Jahangir Aziz is with us, Head of Emerging Markets Economic Research at JP Morgan, on the line from New York. Jahangir, hi, good morning. Thanks a lot for joining us. Your thoughts? Do you think we are likely to go through one more round of money printing by central banks across the world?
Well, it may not be money printing, but clearly central banks, at least the big ones, are in a mode to ease. We have 2 rate cuts for the Fed. The ECB language from Draghi obviously was a surprise, but on the easing side. So I think, you do have a situation where at least the big central banks are now in the easing mode, and that will necessarily have a large impact on emerging markets. The impact on emerging markets already started when the Fed pivot happened in February, and we saw a large number of rate hikes that analysts had actually thought of, that emerging markets, particularly the current account deficit emerging markets, would be forced to put on if the Fed actually raised rates. Those were all taken off. And now we are now seeing emerging market central banks, again, in the current account deficit world, which is where most of the concern was, are starting to put in rate cuts. India's already there ahead of the curve with 3 rate cuts and probably more coming. So I think this is very good news for at least the current account deficit economies, because at least they won't have to face the wrath of global financial conditions tightening exactly when they are seeing some sort of recovery taking place in their economies.
Jahangir, hi, good morning. I want to draw your attention to a Bank of America Merrill Lynch fund manager survey that we've got this morning, where they say that there is heavy pessimism driven by concerns about the trade war and recession, and this is the most bearish survey of investor confidence since the global financial crisis. So my question to you is this: even if we do see a near-term risk on because of the stimulus, etc., in the medium term, do you think the global equity and money market weakness will continue?
Look, I'm not exactly sure whether the global money market weakness will continue. I mean, you can get central banks to put in sufficient amount of rate cuts and easing to keep those markets from going down. But clearly, the economic side is not looking good. I know that there is a lot of hope that a G20 meeting between the 2 presidents will provide a positive resolution to the U.S.-China trade war. But look, if you look at the fundamental differences between China and the U.S., not on the trade front, and I think the focus has been wrongly put on the trade front, but on the non-trade front, on the technology front, the differences are so far apart, and they are so principally different in a gap in their understanding of each other's position, that it's very difficult to see that there is a resolution that takes care of that. And I don't think that you can get a trade deal without getting a deal on the non-trade front, which is where we think the biggest concern is. And that has already had a significant impact, not on the trade front, but on the non-trade front, in terms of the impact it's had on business confidence, global business confidence, and the impact from the global business confidence on global capex. Global capex is one of the lowest we've seen in several years at this point in time. So, the trade war remains a very material threat, and it is very difficult to see how the 2 parties can come to a quick resolution on the trade front.
Jahangir, good morning. Don't envy the position that experts like you would be in. I mean, trying to predict the future when policy at times is moving on Twitter so quickly. But I want to go back to the statement that you made on India, and you said that India is actually ahead of the curve with respect to the rate cuts that we've already seen out here. In that context, and in a global easing environment, can India still hope to attract flows? Because what we've seen in June is that actually foreign flows have slowed down from where we were, perhaps because of our own internal issues. We are also battling a slowdown here. We are battling, a huge amount of leverage issues in our market. So can we still get in the dollars?
Look, you've been asking that. I mean, you haven't answered this, but Lata has been asking this question since quite some time. And my answer is that in a global risk-off environment, it is very difficult to see flows go into emerging markets as a whole. Unless the risk-off environment turns, and the risk-off environment turning depends obviously on how central banks behave, but it also depends to a very large extent on what is happening on the trade front, because at the end of the day, emerging markets, including India, and we like to deny that in India quite a lot, but including India, depends critically on what happens on trade. So if trade, which is the engine of growth of emerging markets, is being pushed back, whether it is, whether for one reason or the other is being pushed back, it is very hard to see where the growth engines will be in emerging markets. And if you add to that some sort of a risk-off environment coming from that, from the trade threat, it is very hard to see capital flows going into emerging markets. So I think really the concern is that that this looming threat of global trade war pushing back on globalization, on trade, which has already taken a toll. If that continues, we are concerned about the fact that this could have a material impact on capital flows into emerging markets.
Jahangir, one last question from my side. Some fear about delayed monsoon or inadequate monsoon. Do you think it's too early to talk about that, or do you think that would be a genuine concern for India going forward now?
Look, it'll be genuine concern for India in terms of what might happen to headline inflation. But my sense is that this RBI has clearly shown its hand that it is biased towards easing, and therefore it will read the incoming data with that bias. And my sense, therefore, is that if there is, a bad monsoon, until and unless the bad monsoon starts hitting headline inflation in a material way, my sense is that they are going to see through the bad monsoon impact on inflation, saying that it is a supply shock and central bank needs to see through it. There are different ways of reading the data. I think the incoming data will be read with an easing bias in mind.
Then a final question, Jahangir. You spoke about, the slowdown in growth a couple of times during our interaction. And as we head into the budget, everyone knows that A, there are no growth engines, and B, the government has exhausted all their fiscal space as well. Do you think this growth slowdown, at least in the domestic market, could be structural and not cyclical, as a lot of people believe?
Well, it has been structural for quite a while. So if you go back to, the place where we really have our concerns, which is corporate investment. So if you look at corporate investment fell in 2009 and 10 and hasn't really recovered to those levels or anywhere close to those levels in the last 10 years. If something has happened for the last 10 years, you would want to start calling it something that's structural. Now, having said that, you have seen some lift taking place in corporate investment over the last, I would say, 3-4 quarters. And I know that just because there is an overall slowdown in headline GDP, no one is looking at it, but there has been a reasonable pickup taking place in corporate investment. My concern is that pickup in corporate investment needs to be nurtured, and has to be nurtured by providing it financing space and space for funding. So if the government and the public sector keeps on borrowing 9.5-10% of GDP as its borrowing requirements, it is very difficult to see where will the corporate sector find funding to start raising the pace of investment growth. So, when we talk about, what can the government do, I think the government right now actually has to do something that sounds counterintuitive, which is that it needs to start moving away from the spending space and starts cutting back its fiscal deficit rather than trying to spend its way out to support growth. I think growth really requires the private sector to have sufficiently cheap funding, and that can only be provided if the government starts withdrawing itself out from the borrowing space.
Jahangir, we leave it there today. Thanks a lot for taking this call for us. That's the view from JP Morgan. We need to take a break, and up next we'll shift to micro. We'll have our list of top 10 stocks.